The Dow and S&P 500 slightly extending their gains, Treasury yields dipping Wednesday after the release of the minutes of the Fed's June meeting. Let's dig deeper into those minutes with Kevin Nicholson. He's Co-Chief Investment Officer for Global Fixed Income at RiverFront Global Investments in Richmond, Virginia. RiverFront Investments Group in Richmond, Virginia, I should say. Welcome back, Kevin.
Thank you for having me.
Well, good to have you with us, Kevin. So the Fed came out with its minutes, basically saying that, in its view, the standard of substantial further progress on the economic recovery had not yet been met. But overall, it was important to be well positioned to reduce the pace of purchases of assets. What's your take on these minutes? More or less hawkish than what you'd expected?
Fred, I think that the minutes were pretty much in line with what I expected. Everyone had seen that the housing market had been, overheating over the last, 6 to 9 months. And so I thought that it was anticipated that the Fed would start talking about tapering with talking about mortgage backs, reducing their purchases of mortgage backs. And that's kind of where they started leaning in this with these minutes. It's going to be, several months before we actually get the Fed to really do anything. Our position has been that the Fed wouldn't start the taper conversation until that September meeting after Jackson Hole. And we think that they're still on track to do that.
So there's nothing that you saw in today's Fed minutes, these headlines at least, that would lead you to believe that they have upped their timetable or pushed back their timetable, whether it comes to talking about asset purchases or hiking interest rates?
No, I think that they're pretty much, like I said, this was a meeting that was filled with beginning to talking about having, tapering disappear or to start tapering.
All right, so no surprises in your view. In terms of the market reaction, we saw the NASDAQ turn positive, the Dow and S&P slightly extending their gains. Yields dipped further. We already saw a dip below 1.3% on the 10-year earlier today. Is that the expected reaction from the markets?
Well, I think that the market is really moving not so much on the Fed right now. The market is moving more on, especially the bond market, it's moving on the fact that you had negative yields internationally. And over the last month, negative yielding debt has increased by about $1 trillion, whereas their borrowing costs there has only gone up by 3 or 4 basis points. But their yields have become more negative over the last month by more than those 3 to 4 basis points. So I think that that's one reason that you're seeing the bond market rally. The other reason is that we're also getting close to the debt ceiling. So there's less supply in the market. And with the Fed having its continued QE, buying, that is adding extra pressure to the market, putting downward pressure on yields. And when you think of right now, the Fed holds 26% of all of the U.S. public debt. So, that has the downward pressure on yields, I believe, is what's causing it to happen.
Well, growth stocks, Kevin, certainly have come back strongly in the second quarter, whereas value took the lead in the first quarter. Is there any sense that the reflation trade or this rotation trade have run its course?
I think that right now we're still in a transition period, and because if you look over the last few months, you've had value outperform at one point in the year, then you had growth outperform, you had inflation become an issue at one point of the year, and now it's not. And so I think that coming into the summer months, this was going to be that transition period where we were going to see all of the data that came in, and that was going to set the tone for the fall. We think that it's important to have both value and growth in the portfolio. There needs to be a healthy mix of both. But right now, obviously, you would like to have a little bit more growth in the portfolio, as that's what's doing better at the moment.
All right, so barbell approach. Thanks a lot, Kevin.
Thank you.
Our thanks to Kevin Nicholson of RiverFront Investment Group. I'm Fred Katayama in New York. This is Reuters.